Good afternoon, and welcome to today's Commonwealth Silicon Valley Club program, brought to you from the Computer History Museum in Mountain View. My name is Steve Wright. It is my pleasure to introduce our guest today, the U.S. Secretary of Treasury, Jacob Lew. Secretary Lew was confirmed by the U.S. Senate in February to serve as the 76th Secretary of the Treasury. He has previously served in the Obama administration as White House Chief of Staff, Deputy Secretary of State for Management and Resources, and Director of the Office of Management and Budget, a position he also held under President Clinton. Secretary Lew began his career in Washington as a legislative aide. For 8 years, he was the principal domestic policy advisor to House Speaker Tip O'Neill, and he was the Speaker's liaison to the Greenspan Commission. Secretary Lew has also served as Executive Vice President at New York University and COO at Citigroup. He is a member of the Bar in Massachusetts and the District of Columbia. Secretary Lew graduated from Harvard and Georgetown University Law Center. I would also like to introduce our moderator, Adam Lashinsky, a former colleague at the San Jose Mercury News and now Senior Editor-at-Large at Fortune. Adam will be joining the Secretary after his remarks. So ladies and gentlemen, let's give a warm welcome to Secretary Jacob Lew.
Well, thank you very much, and thank you, Steve, for that kind introduction. I appreciate the Commonwealth Club hosting this event today. It's great to be here at the Computer History Museum, and it's good to be in California. I want to talk a little today about setting a course for long-term economic growth and the challenges that we face as a nation to secure our economic future. I'd also like to leave time to take some questions from all of you. So let me start with a few observations. 4.5 years ago, when President Obama first took office, America was in the grips of the worst recession of our lifetimes. Our economy was shrinking at 5.4% a year. We were losing more than 700,000 jobs every month. Homes were being foreclosed. Businesses were shutting their doors. Savings accounts were hemorrhaging. Credit markets were frozen. And the American automobile industry was in deep trouble. The president took swift and decisive action to steer the economy out of recession. Right away, he moved to put out the financial fires, to stabilize U.S. automakers, and to jumpstart growth. But while that was critical, it was not enough. So he also focused on laying a foundation for future economic growth. We're talking about investments in education and infrastructure, fixing a broken healthcare system, putting in place new rules so our financial system would work better for consumers and investors, locking in lower taxes for 98% of all Americans, and lifting obstacles so that it was easier for entrepreneurs and businesses to innovate, grow, and hire. Thanks to these actions and the determination of America's businesses and workers, we're headed in the right direction. We must remember that 4 years ago, it seemed nearly impossible that we would be where we are today. But the American people are resilient, and the American economy is resilient. Together, we've taken steps to put our economy on sounder footing. Since 2009, our economy has been steadily expanding. Private employers have added more than 7 million jobs over the past 41 months. And nearly 1.5 million private sector jobs have been added so far this year. The housing market continues to improve, posting clear gains in sales, prices, and residential building. And importantly, housing affordability is near a historic high level. Families continue to repair their balance sheets, and household debt as a share of personal income is now near a 10-year low. Credit is expanding, and business investment has been solid. Healthcare costs are growing at the slowest rate in 40 years. We sell more American-made goods to the rest of the world than we ever have before, and we produce more natural gas than at any time in history. And we're reducing our deficit at the fastest rate since the demobilization after World War II. Now, even though the outlook ahead is brighter, we have much more to do. Unemployment remains stubbornly high. Well, too many people are still struggling to re-enter the workforce. You see, our long-term prosperity depends on an expanding and vibrant middle class. But as we know, trends at work in our economy for a while now have been undercutting what it means to be middle class. These shifts from companies moving production overseas to technological advances that have made some jobs obsolete did not begin with the financial crisis. They did not begin with the recession. If anything, the crisis and the recession lifted the veil on what was happening. And now we're at a point where we have to focus our attention on reversing these trends. Taking steps to restore middle-class security is the foundation of the President's plan to move our country forward. This is a plan that will create more middle-class jobs by improving our infrastructure, increasing our exports, and enlarging our manufacturing base. It's a plan that will expand the availability of a high-quality education by making college more affordable and helping workers to get the skills they need for today's technology-rich job market. It's a plan that will make home ownership more secure by fixing our housing finance system and giving responsible Americans the chance to refinance their mortgages. It's a plan that will let more Americans retire with dignity by unlocking new ways for workers to save for the future. And it's a plan that by doing the right thing and reforming our broken immigration system will strengthen Social Security. Earlier today, I was at the AT&T Foundry in Palo Alto, where developers from around the world are working side by side to create new products quickly. It's a strong example of how bringing bright, driven minds together can fuel innovation. And I want to point out that spurring this kind of innovation and entrepreneurship is a core part of the President's strategy to build a better future for the middle class. In addition to immigration reform and worker training, his strategy includes creating 45 manufacturing innovation centers around the country. These innovation hubs connect businesses, colleges, and federal agencies to help develop world-leading manufacturing technologies. Last year, we started our first manufacturing innovation center in Youngstown, Ohio. What was once a defunct warehouse is now an advanced lab where new workers are mastering 3D printing technologies. High-tech centers like this one have enormous potential. And we believe these advances in manufacturing should happen right here in the United States. We believe more products should be made here in America. At the same time, the President is proposing critical investments in American energy technology. We're generating more renewable energy than ever before, and we want to help establish new energy sources so we can develop more industries here at home and lower energy costs for households and businesses. We also want to help foster technologies that will increase natural gas production and protect our air and water. Finally, it's time to make the research and experimentation tax credit permanent. There's no reason to keep putting this off. This tax credit propels private investment in research and technology, and it helps unleash innovations in our country that lead to new industries, new jobs, and new breakthroughs in production and engineering. Now, even as we work to set the President's economic plan into motion, we face obstacles. One of those obstacles is coming from Washington, where instead of creating jobs, some political leaders continue to create one manufactured crisis after another. Several months ago, we saw one of those manufactured crises become reality when Congress let a series of harsh, indiscriminate spending cuts known as sequestration go into effect. Nearly every part of the federal government is coping with an onslaught of these reckless across-the-board reductions. These cuts are harming the middle class, hampering growth, and hindering job creation in communities like this one all across the country. That's why the President has called on Congress to replace these cuts with sensible, balanced deficit reduction. But even as we work to repair the damage brought by sequestration, Congress must act to prevent yet another manufactured crisis from hurting our economy. In just a few weeks, we'll find ourselves once again perilously close to breaching the debt ceiling if Congress fails to act. As you know, the Constitution reserves certain responsibilities for Congress and Congress alone, including appropriating funds, raising or lowering taxes, and setting the maximum amount of borrowing authority through what's called the debt ceiling. In our history, the United States has never defaulted on a payment. Congress has always upheld its responsibility to protect the full faith and credit of our nation. It's important to note that the debt limit has nothing to do with new spending. It has to do with spending that Congress has already approved and bills that have already been incurred. Failing to raise the debt limit would not make these bills go away. It would, though, have a disastrous effect on our nation. Even a delay of a necessary increase in the debt limit can bring harmful consequences. Keep in mind The receipt of tax revenues and the outflow of expenditures are inherently unpredictable. So it's not possible for us to estimate with exact precision when Treasury will have to depend exclusively on cash on hand to meet our country's commitments, or how long it will take before that cash runs out. If cash on hand were to be depleted, all payments across the government, including Social Security and payments to our military and veterans, would be at risk. Many of you may remember what happened 2 years ago when some in Congress used the creditworthiness of the United States as a political weapon. There was a prolonged and protracted debate about raising the debt limit. The nation and the world watched with growing anxiety as Congress withheld action on extending the debt limit until the last minute. And while that standoff was eventually resolved, the cloud of doubt that took hold and the high-stakes drama that took place actually harmed the economy. The drawn-out dispute over the debt ceiling caused business uncertainty to jump, consumer confidence to drop, financial markets to fall, and economic growth to falter. We cannot afford a repeat of what happened in 2011. We cannot afford for Congress to wait until some unknowable last minute to resolve this matter on the eve of a deadline. We cannot afford another self-inflicted wound. As a widely respected leader from California once put it, and I quote, "This country now possesses the strongest credit in the world. The full consequences of a default, or even the serious prospects of a default by the United States, are impossible to predict and awesome to contemplate." Those words came from President Ronald Reagan nearly 30 years ago. And it is for the reasons that he laid out back then that I'm calling on Congress today to raise the debt ceiling as soon as members get back to Washington after their summer recess. Before I close, I just want to say that, sadly, confrontations in Washington over issues like the debt limit shake people's trust in government. It leaves Americans with a little less faith that we can meet the tests of our time. But the truth is, we can overcome our challenges. Being here in California is a reminder of that. It's a reminder that this is the greatest, most resilient nation on earth, a nation with an endless capacity for renewal and a constant drive to push beyond that last frontier, an indomitable belief in a better tomorrow, and a real determination to work alongside each other to improve the lives of all Americans. There's no doubt that we can head down the path of economic prosperity that awaits us, and I hope we all can work together to get this done. I thank you, and I look forward to answering your questions.
Oh, right there. Thank you very much. So I'm Adam Lashinsky with Fortune Magazine. I'm going to ask a handful of my own questions and then make every effort that I can to integrate your questions, provided that I can read them so that they're written clearly into the conversation with Secretary Liu. Let me start by asking you about the news of the day that's of keen interest to a Silicon Valley audience. What can you tell us about the NASDAQ outage earlier today?
Well, I can tell you that it was over and the NASDAQ was up and operating when we came out here just a few moments ago. The Securities Exchange Commission, which regulates the markets, the NASDAQ, have been working all day on this. I've been kept informed through the day, and I'm glad to report that the markets are up and running.
It isn't the first time something like this has happened in recent memory. So do you have any sense that that Treasury or the White House needs to have a renewed interest in figuring out why this is happening? This obviously just shouldn't be happening in an advanced economy like ours.
Well, technology has enormous benefits in terms of the efficiency and the capacity that it lends to so many parts of our economy, not just markets, but our infrastructure from communications to transportation and energy. There are inherent risks in technology that if machines break, or if a natural disaster occurs, or if there's some malign activity, that it could be very disruptive. We have put in place many contingency plans to deal with the foreseeable circumstances like hurricanes and things like that. We have been aggressive on the cybersecurity front, promoting public-private partnership to make sure that information sharing and remediation methods are well understood and deployable. And sometimes there are just system failures where machines break and they need to be fixed and get up and running, and you need redundancy as much as possible. I think that we'll all know more of the details of exactly what caused today's disruption, but I am glad to say that the markets are up and running.
Do you have any concern that the SEC is not doing its job in regulating the exchanges well enough, given that, as I said, this isn't the first time?
Well, I know that after Hurricane Sandy in New York, a lot of steps were taken to increase the level of preparedness for situations that can arise from time to time. I think until there's a full explanation of what happened today, I want to leave the SEC and NASDAQ in a position to assemble the facts. But I can say that on these questions of exposure to risks from things that can go wrong with cyber systems, it has been something that's been very much on our radar for a long time. It's been very much on my radar in several roles that I've had. And I must say, as I talk to business leaders, it is almost to a person what a CEO tells you they worry about the most, because it's the kind of thing where going through scenarios puts you in a better position to respond if something happens, and knowing how to get and share information is critical. So hopefully incidents that are transient will not cause major disruption. There's no reason, from what I know now, to believe that today's incident has any of the more frightening aspects to it. But we're going to have to learn all the facts. But I think the more general question that you ask about preparedness to deal with problems that arise from our dependence on information systems is at the core of kind of being resilient. And we have to be able to deal with machines that break. We have to be able to deal with storms. And we have to be realistic that there are going to be occasions from time to time when there is a need to respond to intrusions. And I know that it is something that's very high on our list of priorities. Frankly, it's an area where we've worked to try to get legislation passed to even enhance the tools that we have.
So you mentioned risk. Let's transition to a conversation about regulatory reform, which is at I would say, the very top of your agenda. You and the president held a meeting with all the major regulators just this week in the White House, and the message was, we're not getting enough done. There was a study that said that I believe that the regulators have enacted about 40% of the rules required by the Dodd-Frank law, which was passed 3 years ago, and that 60% of the law's deadlines for the rules have been missed. I want to ask you to start off outside of Washington in front of a room full of business people. How is it possible for the government to miss 60% of its deadlines?
Well, I think that the study that you're referring to has certain flaws in terms of how it defines progress made and work remaining. But I don't want to get into the details of that particular study. The Dodd-Frank law was an enormous piece of legislation that is the most fundamental change in our financial system in 75 years. The decisions that are being made in writing the rules are highly consequential in terms of protecting our system from future crises, from protecting taxpayers from being exposed to the kinds of risks and costs that occurred after the financial crisis, and at the same time maintaining what is the most effective financial market in the world so that we remain the world leader financing capital expansion in the United States and the smooth, orderly business operations in the United States. I think that some of the reports on the meeting got the tone of the meeting more right than some of the other reports. It actually was a pretty impressive review of work done. Even in the last 6 months since I've been at the Treasury Department, there's been major progress on key aspects of
share with us one or two key accomplishments of Dodd-Frank implementation so far.
Well, over the last 3 years, we've increased the capital that banks have, and that's very important, because if a bank hits a hard time, that capital is what insulates the risk in that institution from the broader system, and certainly from the taxpayer being responsible. We have living wills, which are if a large financial institution hits the point where it's in crisis, it has to have an orderly resolution plan, which we didn't have at the time of the financial crisis. In the last few months, we've seen rules in place which define mortgage standards, so the most risky kinds of mortgages that were very much at the root of the financial crisis will not be issued, certainly not be protected in any way. We've seen implementation of the international financial rules, not to use jargon, but the Basel III rules, which, the question is, are we at, above, or below the world standard? We're above the world standard. We're setting the pace, and we're going to international meetings. I go to meetings with finance ministers and central bankers around the world, and I say the rest of the world should come up to our standards. So a lot is done. We still have work to do.
Yeah, and so, for example, the Volcker Rule has not been implemented.
So the Volcker Rule is a complicated rule.
Let's just explain. This is to keep large financial institutions from investing their own account, their own money,
right,
which happened in the financial crisis.
One of the things that happened in the financial crisis was institutions investing their own money were in part creating the risk that caused the failure of so many financial institutions. We have a complicated system of financial regulation. There are 5 agencies that have something to say about the Volcker Rule being implemented. I've met with the heads of those agencies several times to try and make sure they're working together to complete the rules by the end of this year, but to do it in a way where, in the end, we don't have 5 different approaches and it's not creating confusion. And I think we're on track for completing it. It did take longer than I would have liked, than anyone would have liked. But the challenge is to get it right, and the challenge now is to finish it and to get it done in a way that works. And
you've said the core elements of Dodd-Frank should be implemented by the end of the year. Will that include the Volcker Rule?
I believe it will. And our regulatory process is a complicated one, and we do proposed rules before they become final rules. I think that by the end of the year, we're going to see the shape of the final main provisions of Dodd-Frank implementation. Some of them may have effective dates that are a bit in the future, but for the financial system, many of these things don't take effect immediately. There's a chance for the regulated parties to adapt and comply. The critical thing is, are the rules in place? Do people know what the standards are, what the new program is? And I'm working real hard to make sure that all the agencies do that. And in fairness to the regulators, they've produced an enormous amount of work over the last 3 years. In derivatives, we've seen an awful lot of rules. In terms of bank regulatory standards, we've seen an awful lot of standards put in place. In terms of stress testing, we're seeing our banks held to a very tough standard. We still have more to do, and we have to do it well, and we have to do it quickly.
So just so we're clear, you do not subscribe to the opinion that the time frame has been a failure of leadership or of regulatory prudence.
Look, I've been in my current role for 6 months, but I've been following this from different perspectives for much of the period. When I was the director of the Office of Management and Budget, per dollar, I probably spent more time trying to fund the regulators than anything else. Because there was a bitter fight in Congress fueled by an industry that didn't want to see Dodd-Frank implemented. So there was a huge effort to slow down the implementation of Dodd-Frank, frankly, with the hopes of repealing it. I think that the November elections clarified things for all parties. There was, I think, a clear realization that Dodd-Frank wasn't going to be repealed. That opened a space where we now are seeing, I think, a different attitude, even amongst the regulated parties, that are now saying, just finish, just get it done. Instead of trying to sort of gum up the works, they'd like to see the clarity of completion. Now, we have to do it right. We can't let the different rule writers be too much influenced by one or another interest that may not be in the public interest. And they're independent regulators. There's some authority that we have to direct things, but mostly they're independent. And my role as Treasury Secretary is to bring them together, to keep them focused on the goals, to keep them focused on the deadlines, and in the many cases where there are multiple parties, to bring them together so that we have orderly, not chaotic resolution of those issues. I think we've made a lot of progress in the last 6 months, and I think we're going to make a lot more progress by the end of the year, and I think we'll meet the standard that I laid out.
You recently said that it may be, after all of Dodd-Frank is implemented, that we still may need other tools to ensure that too big to fail doesn't exist anymore. What did you mean by that, and what do you envision?
You know, I wanted to be clear that, that we are in the process of implementing something very complicated, and we're not going to have an instant perfect test of the system, because frankly, the only perfect test will be a crisis. So we all should hope that we don't get that perfect test. The question,
Agreed. I think we can all agree.
We can all agree on that. So the question will be, when we get to the end of the year and you look at what we've done, have we taken the kind of steps that give you comfort that we can deal with large institutions failing and being allowed to fail, and if they have to? So do you have orderly resolution mechanisms? Can you avoid those failures by having the kind of capital requirements that make failure less likely? Do we have mechanisms in place to protect the taxpayer? And we'll be asking those questions as we look at the rules. Now, a lot of these regulators have more things that they could do if they need to. The idea in implementing Dodd-Frank is not to go to the maximal position on absolutely each issue to say that you've done everything you could possibly do. If you did that on every issue, you could do real damage to our financial system. The question is, have you done enough? And I actually think that when people kind of look at the period from the 1930s to 2008, that's a long time between major reconsideration of, are we keeping pace with an evolving, changing financial system? And we can't do that again. We have to look at it every month of every year. And I think the regulators all understand that. They're in a different mode than they were in before. So even before you get to legislation, there are going to be questions of, do we need to do more?
And so one specific of doing more, Senator Warren and others have effectively suggested reinstating Glass-Steagall that would separate commercial banks and investment banks, which worked pretty well for a pretty long time. Do you and the president support that?
You know, I think that even some of the senators who support that have modified what they say, and they now talk about a 21st century Glass-Steagall. I mean, if you look at the institutions that failed in 2008, many of them, many of the biggest ones were not covered by the provisions in Glass-Steagall. AIG, Lehman, they were clearly on one side of the line. The question is not, do you or don't you reinstate Glass-Steagall? The question is, do we have a regulatory system that reflects the current challenges of the financial system that we live with today? The financial system has changed a lot since the 1930s. So just going back to rules of the 1930s, I don't think is what anyone is advocating.
Fair enough. The sequester. You mentioned the damage done by the sequester so far. What's an example of the damage done to the economy by the sequester?
Look, overall, in terms of the broad economy, sequestration has taken an enormous amount of immediate resources out of the economy. You know, it's probably
government spending. You're talking about
government spending, which is would have produced 0.5 to 0.75% more GDP growth and hundreds of thousands of jobs. So that, kind of in a macroeconomic sense, wherever we are, we would be doing a little bit more. You look at the monthly statistics that come out, and employment in the public sector has been something that's been a headwind. For the first few years of the recovery, it was state and local employment. Now it's federal employment. And that all ricochets through the economy in terms of demand and consumption. In terms of the things that are funded, the damage is quite widespread. You look at research and development. There are reductions in research programs that nobody thinks it's a good idea to reduce. You cut across the board, and you're cutting the good and the bad. You look at our military. It does not make sense to take out of the air fighter wings that we may well need in the future, not knowing if they can go back up, because being out of the air, they may not be airworthy, and the crews will have lost their qualification for flying time. So there are things that you just would not choose to do. The right answer is to have sensible medium and longer term deficit reductions that are balanced, that reflect the kinds of things that are in the president's budget, the kinds of things we have negotiated over the years between Democrats and Republicans. But across the board cuts were actually put in place because they were so unattractive that they would focus the institution of Congress to come to a consensus on an alternative.
And I understand that you were a chief architect of the concept.
To be fair,
In the White House.
I was a participant in a process where, in my remarks, I talked about the situation in 2011. Let's go back to 2011. We were facing the risk of the default of the United States. We had many members of Congress, maybe as many as 100 members of Congress, who were arguing that default was a real option. We thought there were a lot of better places to end up than sequestration. We were unable to reach agreement on any specific policies. We were unable to reach agreement because Republicans were unwilling to put revenues into the mix. And sequestration was the last thing left to avoid a crisis. So to say it was not something we thought made sense, it was something that at the time, if you look at what the president and Republican leaders all said, is it's so bad that the super committee would be able to finish its job to avoid sequestration. Now, having failed to do its job, there are some in Congress who are embracing sequestration as a victory. I find that the truly surprising thing.
The New York Times reported recently that Defense Secretary Hagel has been limited to 4 trips a year to Afghanistan. I wonder if your travel has been constricted as well by the sequestration.
In my current role, I don't have to travel to Afghanistan. I've had the joy of that travel in another incarnation.
I'm going to mix in some questions from the audience. One person writes, please ask the Secretary if he will, quote, pull a Rubin, unquote, and advocate and take action to defend a strong dollar.
I think it would be consistent with not just my friend Bob Rubin, but with all of my predecessors as the Secretary of the Treasury, to say that a strong dollar is good for America.
A strong dollar is good for America. Another audience member asks, the U.S. has a historically low inflation rate. What do you think it will be in 2015?
I'm not going to predict specific inflation rates. What I am going to say is that the economy is growing. It's been growing steadily for the last few years, as I said in my remarks. There are things that happen when the economy is growing that are kind of the natural byproducts of economic growth. So you do tend to see more demand and prices go up. And as long as it's moderate, it's consistent. If it's growth driven, it's healthy. I don't see any signs of, at the moment, of things to worry about. If we focus on the core economy, the kind of growth-driven impact on prices, I think we're in a pretty good place.
I want to apologize in advance for jumping around. It's the nature of the beast with these questions. Do you have any advice for 20-somethings trying to break into the financial services world?
I give the same advice to 20-somethings wanting to break into almost every sector. It's, look for interesting work with interesting and good people, and roll up your sleeves and do whatever comes along. And one thing tends to lead to another. I think over-engineering where you start is a mistake that sometimes people make.
I want to ask a related question about the financial world, the financial services world. Your predecessor, Timothy Geithner, made statements along the lines of that a big and vibrant financial services sector in the United States is good for the United States and the world. Do you subscribe to that thesis as well?
Look, I think we have the deepest, soundest financial system in the world. I think that has been something that's been a core strength of the United States for a very long time. And I think it's important that we continue to have that. It's a very competitive world. It's a different world than it was even 20 years ago. It's interconnected in ways that are challenging. You look at things like financial regulation, and I talked a few minutes ago about the challenge of working amongst multiple U.S. regulators. With the global financial system, we also have to worry about the harmonization of systems around the world, because you don't want business to be kind of attracted to the weakest regulator where you can get away with practices that wouldn't be allowed in countries that are taking prudent action. So in addition to working here in the United States to make sure our system is safe, we also have to work with our international colleagues to try to drive up the standard around the world. And sometimes that's greeted as a friendly effort. Sometimes it's a bit challenging. But I think we are the world leader still, and I'm proud now when I go to world meetings And we're setting the standard in many areas of financial regulatory practice.
But if I could expand on that, I think we can all agree that 5 years ago, the U.S. financial system got too unsafe. That's not a controversial statement. Would you agree that it also got too big?
You mean specific institutions or?
And the overall size of it, that it became, that there's a stream of thought that we as a country became too consumed with finance and not consumed enough with making things, for example.
I think that people talk about the financial economy and the real economy. Obviously, you have to be an economy that makes things and provides real services. But you also have to be an economy that can raise capital for entrepreneurs to go into business, where savings for retirement can be safe and invested in sound ways. And you have to be a place where mortgages are available, hopefully, as we've made the case, increasingly in the private market, not just supported by the government. That involves a deep financial market. So I don't think that the United States economy would be strengthened by trying to kind of shrink the depth and scope of our financial markets. I think if you look at some of the things that were happening before the financial crisis, there was a failure of regulation, a failure of oversight, a failure to see what kinds of risks were being taken. That's a different question.
I understand.
And I don't have a view that there's some right size for the financial market, but I do know the financial markets should be deep enough to support every entrepreneur who's creditworthy, who has a good idea. It should be deep enough to support every homeowner who's creditworthy to be able to get a mortgage. And that's what we historically have led the world in.
So here's a related and similarly tricky question from the audience. An audience member writes, I am concerned about growing income inequality in the United States. The president also has addressed this recently, by the way. Do you see a solution to this problem?
Look, this is a deep concern, and it's not a concern just of the last few years or, as I said in my remarks, emanating from the financial crisis. We've seen for decades, that income disparities have been growing, access to opportunity has been narrowing, and it is something we have to deal with. The president today is speaking to the issue of higher education. Over the last few weeks, he's spoken to what we believe are kind of the foundational issues of what it takes to have a thriving middle class and a growing middle class. The strength of the United States economy is when we grow from the middle out. Just in pure economic terms, it has more of a multiplier effect because people in the middle class tend to consume a bigger percentage of their income. And it gives us the ability to educate our children and bring the next generation up with the skills for an economy that can grow again in the future. It's not a question of income redistribution. It's a question of access to opportunity. It's a question of fairness in the tax code. The beginning of this year, it was very important that we repealed tax cuts at the very top bracket that were contributing to that expanding income disparity.
But excuse me, I'd like to get you to go back to education because for decades there's been no shortage of access to federally supported capital to borrow money to attend college, and yet we're in the situation that we're in where it's ridiculously expensive, students take on debt. What does the president want to do to change a situation where the federal government already has played a large role?
Well, the federal government does play a large role through Pell Grants and guaranteed student loans. We have given an enormous amount of opportunity to an enormous number of young people. For a middle-class family looking at the cost of higher education today, it's a bit daunting. We have two things happening at the same time. Private education has been increasing in cost, so the amount of debt students are graduating with is in and of itself a problem that limits, as opposed to expanding, their life choices. State university systems are increasingly we're seeing a shrinkage of resources, and that's going to mean less, not more opportunity going forward.
And so in headline terms, what are the president's solutions?
So what the president has spoken to in the past is putting in place borrowing practices and repayment options where families and students can afford to repay as they earn so that they're not saddled with debt that is paralyzing.
So
Today, the president spoke to an idea that is a new idea, which is to put in place a metric for being able to see what the value proposition is so that students and their families can see, based on performance metrics, where they really get their money's worth when they pay for higher education. And ultimately, not immediately, but ultimately, the president has called for tying ongoing levels of support to value propositions. So, this is a big issue. I've spent part of my career in higher education. I believe deeply in the power of higher education to be a great equalizer and to open doors of opportunity, but not if middle-class families can't afford it.
This will seem afield, but I think there's an opportunity to comment on an important topic. How does Xi Jinping's articulation of the China dream address the wound caused by China's century of humiliation? What are the implications for China's foreign policy going forward?
Well, I'm not sure I totally understand the question. Let me say this. I've had fairly extensive dealings with the new leadership in China. I met with the president when I was in China a few months ago. I've met with my economic counterparts here and at international meetings several times. I think there is a real understanding of the need for change in China, particularly in economic reform. They understand that in order to maintain levels of growth sufficient to meet the needs of the Chinese people and to play the kind of role China wants to play in the world, that they're going to have a more market-oriented system where they don't send market signals that stop the market from operating efficiently, because they're seeing in many of their industries excess supply that they understand are the result of market system signals that were broken down. Now, this is a hard change because their system is built up around these large state-owned enterprises that are integrally connected to the political system. They're going to have a plenum in October where they're going to be looking at a lot of these issues, and I think we'll have to look to there to see what some of the next steps are. I think that what I've heard in my conversations, and I guess more importantly, what I've seen them say publicly, is that they understand that the things that we bring to them as the things they need to do are things that they understand that they need to do. I think that they're worried about disruption and dislocation, and I think I'll leave the question of foreign policy for someone else to address.
I feel an obligation to ask the following from the audience, and I will be appreciative of a short answer. Your choice for Fed board chair, Larry Summers or Janet Yellen?
I will keep my advice in the Oval Office where it belongs.
I'm intrigued by your comments earlier about centers of excellence for advanced manufacturing. If I heard you correctly, the first one has just opened and there are 40-some more planned. Is there any evidence in recent or even not so recent history that these things have any large-scale impact?
Well, we've only opened one in Youngstown, Ohio, and it certainly has been successful. Look, to some extent, the visit I made this morning to AT&T's foundry is a kind of homegrown version where they've looked at creating a center of excellence where, through collaboration between a large company and small entrepreneurs, they can create new opportunities for innovation and expansion. I think the experience in Youngstown and the competition of good ideas where we could only pick one out of the Youngstown was the choice. There were many other good proposals at the time. I think it's the kind of thing that we can play an important role bringing parties together to make real economic gains.
I'm informed that this is our last question, and I often note that taking questions from the audience it gives me an opportunity to ask impertinent questions that I might not have asked otherwise. And so we'll end, Mr. Secretary, with my asking you on behalf of a member of the audience, why a lawyer rather than an economist to head Treasury?
Well,
This refers to your background and your training as a lawyer as opposed to a financial executive.
I am by no means the first lawyer to be the Secretary of the Treasury. The very first Secretary of the Treasury was, in fact, a lawyer.
Is that right?
And many of my predecessors have been. You know, I'm trained as a lawyer, but I've spent most of my career working in economic policy. I've done it from multiple vantage points. I think that the modern Treasury has a complicated and fascinating set of issues that range from economic to legal to operational. And it calls for someone who comes in with one set of skills, which each of us do, but who has the flexibility and the capacity to kind of move across disciplines. Because in any given day, you'll be called upon to do things that require some set of skills you were trained in and some set of skills you learned on the job. And you know, sometimes you can get an economist. I'm not sure who, George Shultz may be the last, I guess Larry Summers was the last secretary who was an economist. But you've had business leaders, lawyers. You know, I don't want to oversimplify it, but there's no substitute for common sense.
Secretary Liu, thank you very much.
Thank you.
On behalf of the Commonwealth Club Silicon Valley, which brought you today's program, we hope you enjoyed it and learned something to enhance your conversations about these national economic issues. We would like to thank U.S. Secretary of Treasury Jacob Lew and Adam Lashinsky, Senior Editor-at-Large of Fortune, and all of you for joining us. And now, this meeting of the Commonwealth Club, celebrating more than 110 years of enlightened discussion, is adjourned.